Welcome to the Deep Dive, where we cut through the noise and really try to get you the core insights from company earnings calls and more.
That's right.
Today, we're digging into a big one, Figma. They just had their Q2 2025 earnings call.
Yeah, Figma, the collaborative design powerhouse, just had their call, and it's a really interesting picture. You've got strong results, operationally speaking, but then the market reaction, well, it wasn't quite as enthusiastic.
A bit of a disconnect there.
Exactly. So we're going to unpack the numbers, the big product moves, especially around AI, and try to figure out what it means for Figma going forward, for your understanding, really.
Okay, let's get right into it then. Those headline numbers for Q2 2025. Figma reported a record revenue.
Yep, $249.6 million, which is a pretty robust 41% jump year over year, and actually slightly beat what the analysts were expecting.
Okay, 41% growth beat estimates. And earnings per share.
Non-GAAP EPS came in at 0.99 cents. Also a beat, slightly ahead of consensus there too.
So on the surface, sounds pretty good, right? Beat on top line, beat on bottom line.
It does sound good. And it shows, solid execution from the team. But, and this is the crucial part for your analysis, the market sentiment right after the call. Well, it was cautious.
How so?
The stock actually pulled back quite a bit in after-hours trading, despite these strong reported numbers.
Right. So that's the divergence we need to dig into. Strong results, lukewarm reception.
Exactly. That's what we're here to unpack for you.
Okay, let's really drill down into those financials then. Q2 2025 revenue, $249.6 million, 41% year-over-year growth. Beat consensus by, what, about $0.8 million?
Yeah, a modest beat, but still a beat. And that non-GAAP EPS number, 0.99 cents, was just a penny ahead. So solid, but maybe not a massive blowout compared to expectations.
Gotcha. But beyond the headlines, what about the underlying profitability, margins?
Well, that's where things get interesting too. The efficiency looks good. Non-GAAP gross margin was really strong, 88.8%.
Wow, that's high.
It is. It means they keep a lot of that revenue. Non-GAAP operating margin was 5%. And their adjusted free cash flow margin, basically the cash the business generates, was a healthy 24%.
Okay, so financially efficient and their cash position, balance sheet.
Pretty solid there, too. Ended the quarter with $1.6 billion in cash and investments.
And I saw a note about Bitcoin.
Ah, yeah. Interesting detail, right? About $91 million of that cash pile was actually in a Bitcoin ETF.
An interesting choice for a software company. Diversification, inflation hedge. Who knows?
Yeah, it's a talking point. But maybe more fundamentally for the business, let's look at customer growth and, importantly, retention.
Right, because growth isn't just new customers, it's keeping and expanding the ones you have.
Exactly. And their net dollar retention, or NRR, for customers spending over $10 a year, it stayed really high, 129%.
129%. So for every dollar they got from these customers last year, they're getting $1.29 this year, even accounting for churn.
Precisely. It shows the platform is sticky. Customers aren't just staying, they're spending significantly more over time. That land and expand model is clearly working very well for them.
That's a powerful metric. And the overall customer base is growing too, especially the larger accounts.
Absolutely. They hit 11,906 customers spending over $10K a year, and 11,119 customers spending over $100K a year.
Okay, over 1,000 big enterprise clients now.
Yeah, and that $100K plus customer segment grew 42% year over year. So really strong traction with larger organizations.
Okay, so the financial engine looks pretty solid, strong growth, good retention, healthy margins, decent cash. But the market reaction was still kind of, nah.
Right.
So maybe the story shifts to innovation and the future outlook. What really jumped out from the call was the pace of innovation, especially around AI. They had their big config conference, right?
They did. Back in May.
Yeah.
Huge event, almost 10,000 people in person, hundreds of thousands online. And yeah, they used it as a major launch pad.
They announced, what, 4 new products?
4 new products, effectively doubled their product offering in one go. It was a big statement about accelerating innovation.
Okay, walk us through these. This sounds like more than just adding features.
Oh, absolutely. This is strategic. First up, Figma Make. Think prompt to code.
AI code generation.
Right, but with a twist. It lets you create functional prototypes, even whole web apps, from existing designs or just by describing what you want in plain language.
Okay.
But the key differentiator they stressed is that it uses the existing design context within Figma.
So it's not just spitting out generic code. It understands your design system, your components.
Exactly. That's the pitch. Higher quality, more relevant output. Because it's integrated. They're positioning it against what they called AI vibe coding tools.
Right. Okay. That makes sense. What else?
Then there's Figma Draw. This is really about boosting the core visual design tools. Over 20 new features, textures, effects, better vector editing, basically making the core design experience richer. That became generally available in Q2.
Okay, enhancing the core offering.
Yep. Then Figma Sites. This lets you build and publish dynamic websites directly from your Figma designs. Custom code interactions, the works. Hit a publish button, and it's live.
Moving further down the development pipeline there. From design to live site.
Definitely. And finally, Figma Buzz. This one's aimed at brand and marketing teams, helping them create consistent assets at scale using shared design libraries. Think brand consistency.
Okay, so Make for AI-assisted coding, Draw for core design, Sites for web publishing, Buzz for brand assets. That's quite the expansion.
It really is. It paints a picture of Figma wanting to own a much larger chunk of the whole product creation process, from initial idea right through to shipping code and assets.
So connecting this to their strategy, particularly AI, it sounds like they're embedding AI deeply but contextually.
That's exactly it. Dylan Field, the CEO, talked about using AI to lower the floor, make design easier for more people, and raise the ceiling, give pros more power. It's this platform approach using the design context that they see as their unique advantage.
And they're linking this into developer tools too.
Yeah, they launched something called the Dev Mode MCP server. Basically a way to feed that design context into AI coding tools and IDEs like VS Code to speed up developer workflows. Again, bridging that designer-developer gap.
Interesting. And it wasn't just internal development, right? They made some acquisitions.
Correct. Two notable ones. They bought Modyfi.
Okay.
That was for their expertise in motion, animation, and vector tools. So enhancing the visual expression side of Figma.
Makes sense.
And they also acquired Payload. It's an open source headless CMS and application framework.
CMS content management, so bolstering the infrastructure for actually building things based on the designs.
Exactly. Strengthening that whole design to ship stack, building and acquiring pieces to create this, this more complete system.
So building, acquiring, expanding internationally too. I think I saw a note on localization.
Yep, good catch. They localized the product and support for Korean and Brazilian Portuguese users in Q2. Getting positive feedback, especially in places like Latin America, broadening their reach.
Okay, so massive innovation push, platform expansion, international growth. How are they tying this back to the business model? Because all these new products, presumably they cost something.
Right, the monetization piece. They actually rolled out pricing and packaging updates back in March.
Okay, what changed?
Introduced things like multi-product seats, made the admin experience smoother for big clients, and crucially, increase the price for the full user seat type.
So a price hike alongside the new value.
Essentially, yes. And management expect these changes to add, quote, a mid to high single-digit tailwind to revenue growth this fiscal year.
Okay, so the innovation is directly linked to a plan to increase revenue per user or per seat.
That's the idea. More value, potentially higher price points, or more seats needed across an organization using these different tools.
Got it. So with all that context, the solid Q2 results, the massive innovation, the pricing changes, what did they actually guide for the future, Q3 and the full year?
Okay, so for Q3, the revenue guidance was $263 to $265 million. The midpoint there is about 33% year-over-year growth.
33%, okay, still strong, but a deceleration from the 41% in Q2.
A bit of a deceleration, yeah. And for the full fiscal year 2025, they guided revenue to $1.021 to $1.025 billion. That's about 37% growth at the midpoint.
37% for the full year. Still very respectable growth.
Absolutely. And full year non-GAAP operating income projected between $88 and $98 million.
So why the muted market reaction then? If growth is still guided strong, even with a slight deceleration, was it just not enough of a beat and raise?
That seems to be a big part of it. The guidance was seen as just in line. It met expectations, but didn't significantly exceed them.
The high expectations game for high growth tech stock.
Exactly. And combine that with management being quite explicit about near-term margin compression.
Why compression? All the investment.
Primarily the AI investments. They specifically called out higher inference spend, the cost of actually running these AI models. They said they're willing to deepen this investment where we see strong returns, which signals a focus on long-term growth over short-term margin expansion.
Okay, so the market sees strong but not blowout guidance, plus commentary about spending more on AI, which will hit margins near term.
And that combination seemed to temper the risk appetite for investors, especially given Figma's valuation, which is, still pretty high.
Right. Let's talk about that investor context more broadly. Beyond the guidance and margin commentary, what are the key things investors are weighing up here? Valuation is one.
Definitely. That lofty valuation is under the microscope.
Oh,
And the expected rise in AI OpEx, the operating expenses tied to AI, hitting those margins near term, even if it's strategic, that worries some investors focused on profitability now.
what about competition? This space is moving fast.
It is. The whole design and development software world is rapidly trying to figure out AI workflows. There's pressure from big established players. Figma's betting that its platform approach, using that design context we talked about, is its defensible moat. But it's a competitive field.
Okay. And then there's the stock dynamics itself, lockups.
Yeah, this is a big technical factor for you to be aware of. There are upcoming lockup expirations. First, potentially around September 5th, an early release of up to 25% of vested shares for non-executive employees, depending on the stock price.
Okay, that could bring a wave of selling pressure.
Could. And it doesn't end there. 5 of their biggest VC investors have an extended lockup, but it starts releasing in stages after the earnings calls for Q3 25, Q4 25, Q1 26, and Q2 26. So staggered releases over the next year or so.
So a drip, drip, drip of potential supply hitting the market.
Potentially, yes. And on top of that, the CEO, Dylan Field, has set up a Rule 10b5-1 trading plan.
Which is?
It's a pre-scheduled plan for insiders to sell stock. His is set to start in November, allowing him to sell up to about 3.3% of his holdings over time. It's standard practice, often for diversification, but it still adds to the potential supply equation.
So for your analysis, you've got valuation concerns, margin pressure from investment, competition, and this significant technical overhang from shares potentially coming onto the market.
That's a pretty good summary of the headwinds investors are grappling with right now.
Given all that, but also their strong cash position, how are they thinking about using that $1.6 billion? Just funding AI, R&D, or...
They talked about being ready to take big swings, meaning potential acquisitions. If the right opportunity comes along that fits their priorities, has a strong team, good cultural fit, they have the firepower to do more M&A.
So potentially buying more growth or capabilities?
Potentially. Look, despite all these near-term market concerns, management's long-term vision seems unchanged. They want to be the system of record for product creation. Keep executing that land and expand model.
But for investors to really buy into that vision and the current valuation, what do they need to see?
They'll need to see proof points. Sustained growth, ideally still above 30%, combined with a clear path back to expanding non-GAAP operating margins once these AI investments mature, and maybe some of the big marketing pushes like around config normalize.
So it's a show me story for the market right now. Show us the AI payoff, show us the path to higher margins, and let us digest this share supply.
Pretty much. Management is playing the long game, investing heavily. The market is trying to figure out the timing and the impact on the near-term financials and stock price.
Okay, let's pivot to our This Is Not Financial Advice segment. Time to put on our imaginary hedge fund analyst hats. Considering everything we've discussed, strong execution, bold AI vision, but also the market skepticism, margin pressure, lockups, what's an outrageous but plausible trade idea you might pitch?
Okay, outrageous but plausible. Given the tension between the long-term potential and the near-term overhangs, how about this? A leveraged long call spread targeting Figma, but looking out further, say, to Q2 2026.
Okay, a call spread. So buying calls and selling calls further out. Bullish, but with defined risk. Why Q2 2026?
The timing is key. That Q2 2026 expiry gets you past the final major VC lockup release.
So past that major technical overhang.
Exactly. The thesis here is that the market is currently overreacting to the near-term margin hit from AI spending and the lockup noise. It's creating a temporary undervaluation, potentially, relative to where Figma could be in 18 months if their AI strategy pays off.
So you're betting the market is being impatient.
Pretty much. The play would be to buy longer dated, maybe slightly out-of-the-money calls expiring after that final lockup. Then, to help finance it and define the risk, you sell closer to the money calls with the same Q2 2026 expiry.
Leveraging the position while capping potential upside and downside.
Right. You're betting that by Q2 2026, the AI features will be more mature, maybe contributing more clearly to revenue and ARPU. Sales and marketing spend might have normalized post-config pushes. And crucially, the market will have fully absorbed all those share releases.
So you're looking for sustained 30% plus growth to resume, margins to start expanding again, and the technical clouds to clear.
That's the bet. It's a play on management's conviction, paying off over the next year and a half, and capitalizing on the market's current focus on the short-term hurdles. betting that the AI investments do successfully lower the floor and raise the ceiling in a way that translates to the bottom line eventually, it's definitely not for the faint of heart, requires patience.
A fascinating, if speculative, idea playing on that time horizon difference. Okay, what a deep dive into Figma's Q2 25 call. We've definitely seen a company firing on many cylinders, growth, innovation, especially AI, but running into some near-term market skepticism.
Absolutely. They're making big bets to position themselves for what they see as a post-AI software world where design is central. The big question for you, the listener, and for investors is about patience. How long are you willing to wait for those big AI investments to really mature and for those technical factors like the lockups to fade into the background?
It really is that classic tension between executing a long-term vision and satisfying the market's shorter-term demands for growth and margin expansion and managing share supply. Lots to think about there.
Yeah.
For you, maybe the provocative thought is, how much does design itself become a commodity versus a differentiator in an AI-heavy world? And is Figma betting correctly that deeply integrating design context is the key to winning that future? Something to mull over. As always, remember, everything discussed here is purely for informational purposes. It's definitely not financial advice. Please do your own research and consider your own situation.
Absolutely.
Thank you for joining us on the deep dive. Until next time, stay informed and keep learning.